Welcome back to another Explainer. Today, we're diving into a really fascinating case study in retail resilience. We are going to unpack the story of Grocery Outlet, a company with a highly unique business model that recently hit a pretty major speed bump, but is now showing strong signs of a massive financial rebound. We'll be looking closely at their second quarter 2026 earnings, their strategic pivot, and the structural advantages that set them apart in a notoriously cutthroat industry. Okay, let's dive into this.
It's a question that completely defies traditional retail logic, right? How exactly does a grocery chain consistently save shoppers a massive amount of money at the checkout counter, while still operating a highly profitable and scalable business? Usually, extreme value pricing means razor-thin margins that leave literally zero room for error. Yet Grocery Outlet has managed to build a multi-billion-dollar enterprise precisely on this premise. To understand how they do it, we really have to look at the very foundation of their operations.
Section 1. The Extreme Value Grocer.
To get why they're so unique, we've got to look at their pricing, because they aren't your typical neighborhood supermarket. When we talk about value here, we aren't just talking about clipping a few digital coupons. According to their fiscal 2025 pricing research, a typical Grocery Outlet basket is priced approximately 40% lower than conventional grocers and about 20% lower than even other discount retailers. But the real magic lies in their opportunistic sourcing. They buy excess inventory from consumer packaged goods companies, which they call their wow deals. These deals generate absolutely incredible savings of 40% to 70% relative to conventional retailers. And because this inventory is constantly changing, it creates this kind of treasure hunt shopping experience. Customers feel a buy now urgency, which drives repeat visits and fierce loyalty. But extreme discounts alone don't build a sustainable business. You need a structural advantage to keep those costs low.
So unlike traditional grocery chains where a corporate manager runs the store, Grocery Outlet relies on entrepreneurial, independent operators, or IOs. Look at how brilliantly this is divided up. Corporate handles all the heavy lifting, capital expenditures, building out the stores, procuring that constantly changing inventory, and managing occupancy costs. On the flip side, the independent operators who are actually embedded in their communities handle wages, local marketing, hiring, and taxes. This allows Grocery Outlet to effectively outchain the locals with their massive purchasing power, while simultaneously outlocaling the chains with high-touch, personalized, community-focused service.
And here is the absolute glue holding this whole thing together: 50%. Independent operators generally share 50% of the store's gross profits with the corporate headquarters. This is a massive shift from standard retail. By giving the IOs a true 50% slice of the pie, corporate and local incentives are perfectly aligned. The harder the independent operator works to merchandise effectively, control shrink, and serve their community, the more money both they and the corporate office make. It's a high-reward system that incentivizes incredible operational efficiency right at the store level.
Section 2. Expanding too fast.
But, even the most brilliant models can be pushed past their breaking point. After aggressively expanding their footprint to 547 stores across 16 states, that rapid growth came at a steep cost. In the first half of fiscal 2026, the company reported a massive $158 million goodwill impairment. This is essentially an accounting charge, acknowledging that past acquisitions or expansions just aren't as valuable as originally thought. This non-cash charge was the primary driver behind a highly painful $174.7 million net loss for the first half of the year, and that was despite pulling in $2.36 billion in net sales over that same period. The reality was setting in. Adding stores to a map is easy, but ensuring every single location has a viable path to sustained profitability, that is incredibly difficult. But management didn't try to sweep this under the rug. During an earnings call, CEO Jason Potter plainly stated, "It's clear now that we expanded too quickly, and these closures are a direct correction." This level of direct accountability is absolutely crucial in a turnaround story. The company recognized that in their eagerness to scale, they opened locations that couldn't effectively support the business model, which was diluting the productivity of their existing footprint and seriously pressuring margins.
Section 3. The Optimization Plan.
Recognizing the misstep, leadership hit the brakes and shifted gears with an immediate action plan focused on strategic consolidation. First up, they identified and closed 36 underperforming stores that simply did not have a viable path to long-term profitability. Second, they completely revamped their real estate strategy.
Instead of far-flung expansion, future growth will emphasize a much tighter, clustered approach to new markets to optimize supply chain efficiency. Finally, they bit the bullet on the financial end, estimating $15 million to $24 million in net restructuring charges across fiscal 2026 and 2027 to exit these leases and operator agreements. It was a classic addition by subtraction strategy designed to stop the bleeding and improve overall cash flow.
Section 4. Signs of a turnaround. So, the big question. Did this aggressive plan actually work? Well, looking at the immediate financial impact of management's focus on profitability over pure scale, analysts on Wall Street had estimated an adjusted earnings per share of 12 cents for the second quarter. Grocery Outlet blew right past that, posting an actual adjusted EPS of 20 cents. That's beating estimates by over 66%. And this brilliantly illustrates that shedding the dead weight of those 36 underperforming stores immediately boosted the bottom line and operational efficiency.
But here's what makes that earnings beat even more impressive. Despite having closed dozens of underperforming stores, the company still managed to grow its top line, hitting $1.19 billion in net sales for the quarter. That's a 1.1% increase over the previous year. And even more importantly, overall store traffic actually increased by 1.8%. Customers are clearly still hunting for value, and Grocery Outlet is successfully getting more foot traffic through the doors of its optimized, highly productive locations.
Now, what's really interesting about this slide is the dramatic transformation of their balance sheet. Back before their IPO in 2019, their net leverage ratio, which basically measures how much debt they have compared to their earnings, was a somewhat heavy 5.8 times. Fast forward to Q2 2026, and they've reduced that leverage ratio to a very healthy 1.8 times, with an interest coverage ratio of 8.9 times. This means they are not crippled by debt. In fact, they ended the quarter with $74.2 million in cash and $154 million in remaining borrowing capacity. This gives them the exact financial flexibility they need to fund future, smarter growth.
Section 5. The road ahead. With a much cleaner store fleet, a highly profitable quarter in the books, and a rock-solid balance sheet, management is absolutely radiating confidence right now. They significantly raised their full-year 2026 guidance, now projecting net sales north of $4.7 billion and adjusted EBITDA between $225 million and $235 million. And remember, they aren't abandoning growth. They are just being way smarter about it, planning to open 30 to 33 net new stores this year using their new clustered strategy. They're also reinvesting in the customer experience, rolling out a store refresh program to 100 locations to improve layouts and value messaging. Wall Street loved this forward-looking confidence, sending the stock popping over 9% in after-hours trading following the Q2 report. It's just a fascinating pivot. Grocery Outlet learned the hard way that you can't just force a highly localized, independent operator model into any random market purely for the sake of a higher store count. But by course-correcting, cutting their losses, and leaning heavily back into that 50-50 profit share that empowers their local operators, they've stabilized the ship. So the ultimate question to take away from this explainer is, as inflation continues to pressure consumers, will Grocery Outlet's newly optimized small business at scale model become the new blueprint for discount retail success? Thank you so much for joining me to explore this data, and I'll see you in the next explainer.